Well, Marty, thank you for this opportunity. I think that this right now is potentially the most interesting hour of your conference, and it's not because of me or the four outstanding panelists that we have, but this is a fascinating time in history, absolutely. So they say that necessity is the mother of all invention, and it almost seems like policymakers got together and said, okay, let's start a war, create an energy crisis, a food crisis, a recession, and then we'll innovate our way to a clean, sustainable planet. Another way to put it, I think, is Harold Hamm, who is a North Dakota fracking giant, the head of Continental Resources, said too much EQ, not enough IQ. And what that means is, yes, we all want a clean, sustainable planet, and the idea of switching to renewables in policy has run into some serious problems. So the layout of today's panel is this. We have 60 minutes, 4 speakers, that's 15 minutes per. So for the first 5 to 10, I've got, for the first 5 to 10 minutes of each of the 4 panelists, I'm going to have them try to address 2 questions. I'll remind them before they speak. And those questions are, how has ESG evolved, which is hence the, Chester, you're sideways. I don't know whether you realize that.
Let me see.
I'm getting vertigo here while I was trying to speak. There you go. That's a lot better. So the first question will be, how has ESG evolved and what the definition is and where are we today? And the second is, what is the rational pathway forward so that we can solve this energy crisis and actually create a green, clean future for ourselves? Before I introduce our talented panel, I'm just going to say a couple things as background. One, in terms of ESG public funds and ETFs, that basically several years ago, people started marketing these funds. They became tremendously popular. And basically what a lot of these people did was essentially, ultimately, with hindsight being 2020, fraudulent. They'd take a mutual fund and say, we'll get rid of Exxon and all the energy stocks, and we'll just double up on a bunch of FANG stocks. And we'll say, hey, we're not contributing to carbon to the economy. We'll just call that ESG. That was great for the last 7 years. And so people could feel good that they're doing something right for the environment and they're making money. Suddenly, this is not working. The fees on the ESG funds, some of them were fairly high. So suddenly people have overpaid and they're starting to ask questions. And because of all the FANGs and tech stocks, their performance is having some difficulty. The other element that people need to understand is that this transition to a clean environment has not worked well. And I think a good way to look at that is the transition as it was led by Angela Merkel, saw Fukushima, the nuclear accident in Japan in 2011, said, well, we got to get rid of nuclear. We're just going to switch all over to wind and solar. And they implemented that. And last year they didn't have any wind. And suddenly they drew down their saved energy from wind, and they didn't have enough. And there were energy shortages that we were looking for all last winter, and we started to have it. And then you get the Ukraine, because Vladimir Putin has utilized natural gas as a weapon, and that's really created a serious problem. And that is what has caused this current energy crisis. And I'm hoping I'm properly laying the table here, but I'm going to throw out a couple other things and then pass it on to our talented panel. First, 85% of baseload energy comes from fossil fuels and 15% from renewables. Secondly, I was listening to Jeff Curry this morning, and he's the Goldman Sachs commodity analyst. He said 9% of S&P earnings are out of energy, yet it's only 5% of capitalization. And anybody who's looked at the energy sector over the last decade has watched energy go from 20% to 2%. And frankly, I do run money. And if anyone wants to send me some, I'm doing very well. And that's because I'm all in commodities. And commodities, I think, are going to continue to outperform because basically that's going to force higher interest rates, and all the valuation models are now upside down, but nobody can think that way unless they're 60 years old, which I happen to be, and I studied economics. The last thing is 40% of carbon comes from manufacturing. So in other words, we often look to the energy sector as the primary source of carbon, but a lot of things are made and then go into a dump. And if we can find better manufacturing, we can really reduce carbon. So real quick, I'm going to introduce our panelists, start with the ladies, then Louis, Medina, and then Chester. And first we have Jennifer Warren, and she runs Concept Elemental. I've known her for a while. She's a published writer, analyst, and expert both in investing in fossil fuels or traditional energy, but also an expert in new ESG technologies. And then she'll be followed by Caroline Abramo and Louis Medina, and then Chester. And I'll introduce them right before they speak. So Jennifer Warren, could you please tell us what your take is on ESG and sustainability? And then where do you see the energy transition going? And I'm looking for about 5 to 10 minutes.
Hi, thanks, Tyson, and all the other panelists, August panelists here. So ESG evolution, ESG, sustainability, impact investing, all of that has been in the mix for a long time. The vernacular ESG, I don't even know when it first got coined. I'm sure somebody here does, but it's become more of a, I'll call it today, it's a filter for some looking to invest. It's a framework for others, depending on what type of investment firm or fund you're in. It's also a catalyst. ESG is driving investment in a lot of different ways, and we see large firms, large publicly traded firms, well, all sorts of firms. I mean, it's trickled down into private firms as well, where everyone's trying to improve their ESG profiles, their ESG ratings for all kinds of reasons. And so it is a catalyst to spark capital, but it also has limitations. If you're just focusing on that, you might miss other things. So now I think your 2.0 framing, Tyson, I think it is becoming more practical, the whole universe of sustainability, ESG. And I think that energy security, which is kind of what you were referring to, has become more at the forefront. Yes, absolutely. We're concerned, and we need to be concerned about a sustainable planet, green investment, green tech, reducing carbon emissions, all that. The climate science supports it, whether you believe it or not. Less pollution is good. Doing things better is good. And also, I think within this whole ESG space, capital wants to be more conscious. And I think, like, for example, Caroline, I know that's kind of her wheelhouse too. And there's also all this capital sloshing around. There's a lot of liquidity. So my other concern is that our capital resources get used properly for sustainable resources in the future. Now, where we're going, where we should be going, the other part of your question about the energy transition, I've been in this space really hard since about 2003. And I've been chronicling all the shale booms, natural gas, oil, because I live here in North Texas and I'm around all the innovators that have been doing it. So I've been sort of inside that story, talking to all the firms that have been participating in that revolution. But where we should be going, so I swing back and forth between sort of my boots on the ground hat and my aspirations. And that's how my investment portfolio looks, actually. I think the transition is a bit accelerated because of the conscious capital concerns about climate change. So that's driving a lot of this acceleration. And at the same time, we have obstacles a la the Russian invasion, what it's revealed in terms of, where we are with the investment cycle in terms of oil and gas. We know there's underinvestment that's reflected in the S&P capitalization you just mentioned about energy. And that's going to take a while to fill that investment gap back up and get things balanced. So oil prices definitely are going to be high. What we need to be doing, just in a quick, 30,000 feet, yes, we do need to add renewables to, all types of renewables to reduce carbon emissions. Yes, we need to switch less coal, more natural gas just to get cleaner. We can't let the perfect be the enemy of the good. And then also energy efficiency plays are important. And there's a lot of firms in that space, a lot of tech in that space. We also need to produce fossil fuel more cleanly. And I think a lot of the firms I follow, the publicly traded ones, they're trying to do that. It's part of their ESG rating, but it's also what they need to be doing, and they're doing it. And I think also we need to care about who pays this green premium. Private capital, firms, both public and private, can do the heavy lifting, let the market do it. I'm concerned that government policy will screw things up. So I very much believe in market-based solutions. There's a lot of good government policy too that supports, basic science research and all sorts of things. But the politicization of energy and sustainability is not good for anybody. There's a lot of tech that needs to be dusted off the shelves and considered, low cost is key in reducing carbon emissions. So it needs to be done practically. So that's what I would say in my 5 minutes or whatever.
That was a little over 5 minutes, which is perfect. And the idea is to kind of set a general discussion, and I want to introduce everybody, and then we can delve a little deeper into areas of particular interest. The next outstanding speaker is Caroline Abramo, who worked at Goldman Sachs, I believe, smart as a whip. She runs Pana, which is Pana LCE, which is low carbon economy. Fortunately, she has her icon right there. And I spoke with her a little earlier this week, and she's going to touch on ESG sectors and what the real ESG is. But the question again is, how is ESG evolving, and how do you see things moving forward?
Okay,
5 to 10 minutes.
Okay, so thanks, Tyson, and thanks, Marty, for this opportunity, and thanks to my fellow panelists. And it gives a little bit of my background yesterday, so sorry if it's a little review. I started my career as a natural gas derivative trader in the mid 90s, when the natural gas contract on the NYMEX was very new, as was the WTI contract. And what's important about that time was it allowed a financial mechanism for producers of energy to actually lock in long-term revenue, which, as a banker, so I worked for several banks, we were able to lend a lot of money to the space, and that really pushed forward growth exponentially, and it really led to the U.S. being an independent energy producer. I was involved very much in the early days of shale technology, LNG technology, and then into renewables. But that ability to lock in those revenues and with surety gave the companies the ability to spend a lot and to grow very quickly. And that's a concept that we really need right now. With renewables, we have long-term PPAs, we have long-term contracts that a lot of the renewable companies are able to sign with utilities, which allows for that. But some of the newer areas that we're talking about, Tyson mentioned some of the harder to decarbonize sectors like industrials, we don't have a hedging mechanism. What we have, though, is a customer base that would buy sustainable or lower carbon cement, steel, glass, materials. Every big packaged good company in the world, Unilever, Colgate, Mars, they need sustainable products because they want to change their carbon profile, their GHG profile. They want to reduce it. And they've actually put out to the marketplace in guidance to shareholders, stakeholders, that they are going to do that with some very, very tangible goals. And in my experience over the last 25 years of, being a trader, but then being a banker to these companies and sitting down at the table with them for many years, I will tell you, ESG it's always been front and center with these companies, especially the E, but the S and the G as well. And so this isn't, as everyone said, it's not this is really not a new concept. It's new. It's really more new to maybe the investor or the thinking of the framing or a way to prioritize or let's say fast track companies that maybe invested in that do ESG right. And Jennifer mentioned there's tons of scoring methodologies out there. I think there's probably more than 50 different analytic groups that can score. And Marty's talked about in the last session, just ESG stocks or indices have been getting hit. And so it's very, just to say, it's very confusing to an investor, and especially if you want to work in liquid markets and you're looking at specific companies and saying, well, how good are they at ESG? So just to say, it's a bit confusing, the framework, but over all my years working with these companies, I've never seen such an acceleration of interest, both certainly on the E side and with carbon, and literally now the SEC is requiring companies to report their scope 1 through 3 emissions, and I could go into some of that with all of you as well, what that means, but it means that it's transparent. So there's a whole technological field that's evolved from just the verification of a company's carbon footprint. Then there's monitoring, and then there's reduction, and then there's trading. And so, and interesting with my past and a lot of my teams being a commodity trader, we see this opportunity that you can trade credits in the market. So if you're a big emitter, you can buy credits, or if you're actually generating credits, you can sell them. So there's actually a framework, and we've been talking a lot amongst countries and globally about a carbon price, which today could be anywhere from $20 for a nature-based project to $500 for an energy-based project. But leaving that to the side, I will just mention for a minute or so how Pana has taken this ESG internally, and so how we present ourselves as ESG. So Jennifer mentioned, we invest in private companies. So we are private equity, we're private growth equity. And we did that intentionally. We invest in technologies, late stage climate technologies that are ready to be commercialized. So we're working with the very corporations that need this technology now more acutely because they have these goals. And we actually have we've developed a Pana network tool to actually match up the supply chains with the technologies that they need. But we are focused on the space because there's a lack of capital that's going into growth equity. Lots of capital goes into venture, lots goes into infrastructure, but in the middle, there's a big gap. And we did this intentionally, and that we could scale capital. So a growth equity check to a company of $50 million could scale into 6 or 7 projects that are worth $100 billion. And that's exactly the trajectory we need. We need to spend trillions of dollars to get to Paris Accord goals. So we're very mindful. So E of the ESG, check for Pana, and then the S and the G. This how we show up, I think, has a lot of integrity and is quite natural. Is that we work with our companies that if they don't have a diverse slate of on the management team or on the board, then we work with them over our hold period, which tends to be 5 to 7 years. It could be up to 10 years in our fund, that they actually can hire if they're going to hire folks, which they always are, because they're growing, that they be diverse people. So there's a natural way that we're thinking about changing that dialogue. And then clearly when we're investing in a company, we look very much at their governance structure. So that in private equity is, I think, a little bit easier or more natural to affect because there's still room for that growth. We hope to make, or with those guidelines, have these companies when they go public and or get taken out by a large public company, they show up with better ESG metrics. And the last thing I'll say, if I have one more minute, is that so we run a private strategy, but because of my experience in public markets when I left Lazard in 2019, I was a portfolio manager for their real assets fund, which was 300 public companies in real estate, infrastructure, and commodities. So again, using my time, with the corporate, the C-suites of these companies, but there's a very clear strategy of like a crossover. There's lots of private companies that are going public. The SPAC vehicle was very popular last year. It's slowing down a little bit, but much we have in terms of, these public companies. And what I will say in terms of what I see in terms of public companies is that trying to create a metrics, trying to, have an analytic that ranks it. And as everyone has already said, it's favored big tech companies, large cap companies. But another strategy that has been, deployed or by a few firms, specifically, a lot of you might have heard of the Engine One and their work on activist work with Exxon, but they actually have a strategy, which is they have an ETF that actually looks at the proxy votes of companies towards in terms of ESG types of voting and measures, and ranks them according to that. And so without stealing their thunder, it's actually a very interesting strategy that's out there. And it actually, for us, we align to because they identify companies that we would be working with anyway, actually some of our biggest priority companies. And where we step in is that maybe when they do their work in terms of, maybe getting new board members, there's like that identification. Pana comes in for execution. So we're really coming into with the corporate and saying, okay, now you have to do these things, like let's do them together. So anyway, but there are wanted to point to that there are different ETF or different ways of thinking about ESG that in my opinion are that have integrity and that do actually show real impact that the companies have or real movements towards ESG.
Caroline, thank you very much. Our next talented speaker is Luis Medina, and I spoke with him, and it was very entertaining because we couldn't throw enough equity ideas in the commodity space at each other fast enough. We had to stop and agree to talk later. Luis is the head of investment strategy for CMG Capital Management. He went to Brown. He's very bright. He's an equity analyst. He looks at the market. And Luis, you got 10 minutes. Could you tell us a little about the energy crisis and what sectors you're liking and how bad do you think things will get? I think one thing that you said to me that was really fascinating is Europe has been an innovator in terms of developing environmental technologies. And you said, well, this summer, these guys are going to have to start burning coal for a social reason because they're so short of electricity. Even though it's generating all this coal, people starving, people not having electricity is more problematic. Luis, go ahead.
Yeah, so something became apparent, and I'll kind of give a little backdrop. When I made some initial investments in my family holding company, of which I'm the CIO of. I also work as an investment strategist for an SEC RA, which is CMG Group, and I'm also an analyst for Ameris Securities, which is a broker dealer. Now, within the family holding company, and which had also helped shape some ideas that I brought to clients on a firm level at CMG, is we made investments in coal back in 2020. We also made investments in uranium. and nuclear in 2020 for different reasons. We made the bet on coal in 2020, not because of what we would typically think of a reason to go into coal, which is thermal energy and for production of energy, but really on metallurgical coal, coking coal, making a big bet on infrastructure. Well, fast forward a year later, we begin to realize that there's an energy crisis emerging in the summer of 2020 in Europe. Now, fast forward a few months later, Russia invades Ukraine. Now we have an explosive energy crisis, and it just so happened that it was happening at a time where it was still cold, but spring was around the corner, and now there's a little bit of time to be able to make actionable decisions and policy decisions to help reduce the impact on the dependency of Russia for energy, particularly in Europe. So as a result of Russia invading Ukraine and the energy crisis, well, that evolved our thesis in the coal play, at least in the short term, which is on the social component of ESG. Well, if you're not using coal in Europe and you're dependent on natural gas or crude, well, there's a problem. You're still financing Russia, and even if we have these moratoriums or we put these sanctions in place, the likelihood of Russian oil getting exported to India or other export countries that are still importing Russian oil, and then it getting refined and blended into other petroleum commodities that end up getting exported to the US and to Europe, it still finances the Russian war machine. And so on the social component, and it's hard for most of the folks on this, listening to this panel to think about coal as an ESG play, but with respect to not financing a war machine in Russia, which can, easily spread and permeate the geopolitical landscape in Eastern Europe, which is already being redefined. Coal is critically important on the social component, not environmentally friendly by any stretch of the imagination, even though there are clean coal technologies that are still evolving, and there's some advanced technologies going there that will help reduce the environmental impact in coal. But there, from a social standpoint, it is given where the prices of natural gas and crude has evolved to and where it's continuing to go up, it is critically important to reconsider the use of coal, particularly in Europe, as we're entering winter. And I think as much as Europe has shunned coal, and for environmentally good reasons, it is an important part to secure their energy security in the short and intermediate term, maybe a couple of years until either they continue to expand renewables or to strongly reassess their positions in nuclear that happened post Fukushima. So I'll go to the other part of uranium or nuclear, which usually gets people off guard when I talk about coal and nuclear in the same conversation. But nuclear is also critically important. I'm going to share. I just pulled up a couple of quick web pages that will help illustrate kind of where the uranium and nuclear play is. Okay, so this is an ETF. It's the longest lasting ETF with exposure to uranium. It's the Global X Uranium ETF. It's not a pure play in uranium with the miners, but it does have exposure to the commodity. It does have direct and indirect exposure to the miners in uranium. Well, I'm sure a lot of the folks here remember this period. This was before this period, you had the commodity super cycle going from arguably 2003 to 2007. So you probably had a little higher peak here, drop down. Then you had what should have been a more sustainable price point for uranium mining companies. Well, we had Fukushima, and then we plummeted. Okay, mining operations stopped. The cost of commodity of uranium per pound plummeted, and all of that seemed to stop or slow down somewhere in this range, partly due to the fact that we started to become pretty aware that we are going to enter a shortage of not uranium in the ground. Let me be clear, there's plenty of uranium in the ground in sub-Saharan Africa. We have uranium in the ground here in the United States, Canada, Australia, Kazakhstan, plenty of uranium deposits in the earth. But in terms of yellow cake and fuel rods, that's where we entered our shortage in the end of 2020. The United States thought it was worthwhile putting a $75 million strategic reserve, start acquiring uranium. You had Sprott Asset Management establish a closed-end trust last year. They've been scooping up. If you look at their regulatory filings, it's continued to ramp up from, I think they started off at like 100 million or 150 million. Now it's probably at 3 billion that they're taking uranium out of the market. Uranium out of that's already, uranium in a can out of the market, gone. And so it's being stored. So we have these competing forces. You add into supply chain issues, you add in the fact now we have Russia invading Ukraine. Well, Kazakhstan, respectfully is has a puppet government that is going to, be swayed by Russia. You have Russia that controls about 40% of the global uranium fuel rods out there that supply nuclear reactors. So now we have sanctions that are affecting exports for those fuel rods. I want to show you another screen, because now you have a kind of the perfect storm. So over here, this is from the World Nuclear Organization. This is great to get some public information about what's going on in the world of nuclear. So there are about 440 nuclear reactors operational today globally in about 32, 33 countries. This highlights power reactors that are under construction across the globe. What you'll notice is that China and India will dominate the number of reactors under construction. These are ones that have been permitted and approved and ready to initiate construction. This is just 2023, 2024, 25, 26. And you'll see now one other little factor, reactors with megawatt energy above 300 or 400 is considered a regular reactor once you start to get below 300 or 400. So that would be one of the micro reactors. Here's another one in Argentina. But this, so there, suffice it to say, excuse me, I'm getting.
You're okay.
No, it's I'm getting. Excuse me.
You're getting a robocall?
No, my computer is reading the text, so excuse me. Sorry about that. I was having a technical issue. So with respect to we're in a supply shortage. We have this many reactors beginning construction. We have about that many reactors globally completing construction every year over the next decade. So now you have a perfect economic supply demand constraint. Here's another factor about uranium that folks aren't realizing. There's very limited applications for uranium globally. It's industrial and power utilities. So when you add into those factors, it's an inelastic price. It's going to be shed to the consumers. But at the same time, guess what? Uranium is still more efficient in terms of energy production. It produces a heck of a lot more energy than fossil fuels and renewables. The reality is renewable energy, it's great it's great at being clean and green, Nuclear is not clean, but it is green, and it materially impacts the zero carbon footprint initiative. And so when you think about renewable energy to supply the energy in New York City, or where I live down in the Coral Gables, Miami area, metropolis of 8.5 million people between Palm Beach and Miami, renewables aren't going to do it independently. The other issue troubling renewables and the proliferation of renewables to be a permanent replacement is the fact that energy storage is a huge issue. The top most advanced lithium battery technologies can still only store about 8.5 hours. We need to be able to advance battery technology to hold and store energy for 10 to 12 hours. Maybe in a decade, we can tweak lithium batteries in that direction. But we're gonna have to look at to aluminum ion batteries and other battery storage technologies to be able to really bring renewables in a more sustainable way. So the big bet is coal in the short term for ESG, for social. It's also necessary for energy security for populations, particularly in Europe. And then nuclear is I have a strong thesis on nuclear and on the long term. Prices still haven't been one other thing I'll comment on before we transition is just, well, it's a split between the two plays. So what you're realizing in coal right now, even with the jump up in the companies that survived restructuring over the last decade, okay, the remnants of those companies and they're thriving in today's market. Even so, you look at Peabody Energy, you look at Arch Coal, their prices are up, probably anywhere between 500 and 800% over the last 2 years. Now, bear in mind, and I think
We're going to come back to you.
Okay, go for it.
So I'm trying to keep it fair, give everyone, and then you did a wonderful job, but the idea is to cover everything and then we're going to drill down. So
Great.
We're moving on now to Chester White, but this was the way my conversation with Lewis. We couldn't wait to talk again because there were so many things that were interesting. So Chester runs Helios Alpha. Chester, tell us about your organization, how you see the energy transition. Marty told me a little about you're buying distressed companies and funding them. And where do you see some of the hottest opportunities? And after you're done, what we'll do is I'm going to ask everyone what their favorite idea or sector is and take questions. Go ahead,
Sure.
Chester.
Thank you very much. So our fund is a public only fund. And so we have had some nice opportunity to watch ESG evolve in the more regulated environment as opposed to private. And so the S&G has always been scrutinized. It's been evolving nicely to become more diverse and more disciplined, but the E has been a bit of a mess, right? In the kind of the context of, well, what falls in ESG? It's been clearly manipulated and greenwashed, as we said, and hopefully this last batch of dysfunction, and I will chime in on our biggest public E company, at least in our time, in my mind, has been Tesla, and they've been booted out of the ESG for the S&G, but not the E. But I would note, I think that this kind of dysfunction's rising to a new level. It's rising to a very publicly aware level, and the standardization of some of these processes. As you say, there's 50 scoring mechanisms to get that standardized into a more consistent Moody's-like flow that people can count on. That's a little bit more legitimate. I think the window of opportunity has risen up, and hopefully we'll come out of this with something that is more meaningful to investors and more consistent. So it's nice to see this hit the wall a little bit and have Tesla get booted out. In a sense, it draws attention to what the kind of like, well, let's hope it is a final step or a good final step towards getting the oil companies to stop manipulating and many of their greenwashing efforts to stop manipulating the ESG label and get it to really back to, and I would say back to something that would pull Tesla back in. And I would only note I think it was yesterday, they had their big, third wave of global energy infrastructure transformation pitch over at Tesla. And I think that has to be admired, right? So we'll hopefully see those guys pull back in, but more so, hopefully, the attention that they brought in the dysfunction there will drive that standardization that people really want, because getting into what's the rational pathway that we seek now and getting really impacting green and clean, I think you have like a bit of a Cinderella story right now at this moment in time. Because, 5-10 years ago, you were never in the absence of skeptics saying, I don't even know if global warming's real, right? And now with the droughts and the ice caps melting and the heat in some places like India so bad you can't function in a day, there's no more debate. It's the real deal. And that foundation is deeply embraced, I think, by the globe at all levels, consumer level and individual level through a government level. And to the point where obviously, 2-3 years ago, it drove an investment bubble, which it made, that bubble is fortunately now burst, but it made it almost uninvestable from a public standpoint. You had like the green tech world get to be so overpriced. We could not allocate to it. We're actually net short green tech, even though we're long primary capital green tech funds. We were net short the ARC funds and so many of the other bubble type of stocks out there, from autos and et al. And EV. It became out of control. So that bubble bursting, and it's come down now for 18 months, is a real gift, because now we can get back to work and we can start putting primary capital work and make our investors money, because that's our mandate, is to, obviously, like all investors, we have to, we want to impact green in a good way, but we still have a mandate to have a good return for investors. And now it's available, right? So we are actually beginning to pick away at some of the bottom of the green tech market. We're still using some of the tools that we use for the fund, like we'll do a little bit more debt, or convertible debt, as opposed to straight equity. But at least it's investable, and in places like China, you can get a good price on things like Li Auto versus maybe Rivian, who's still in a little bit of a bubble environment, right? But it's nice to see it investable. And this capper, which I know is a terrible environment, but the capper of all cappers, the third leg of the stool, is really $120 per gallon oil, right? And that drives the demand, of course, for all of your solar, wind, hydro, and EV demand even harder, which puts the wind at the back even more. So that is really a fantastic, if you want to make this energy transition happen even faster, 120, let alone 130 or 140 gallon oil is a massive plus to get people off the dime. So with that said, we're really more optimistic than ever, even though looking in the rearview mirror, ESG and green has been a train wreck for investors for the last 6, 12, 18 months, right? Because of the bubble. Now, I think you can really get back to making some money, and the wind is just howling at your back in terms of EV adoption is going to be harder, or quicker and faster and bigger. And even things which I have to agree with the prior speaker about nuclear, which had been a bit of a taboo. And, it's a longer term cycle on nuclear. Even that's now, people are getting more realistic about it. And even politicians are beginning to talk about it as, mathematically something that if you're going to make your bogeys of getting green, you really have to adopt some of the nuclear efforts and make that happen. So just in general, we're actually tremendously bullish and optimistic about getting the transition and a pathway to green right now. Again, broad acceptance of there being a global environmental problem is now locked and not debated. It's investable as the bubbles burst, and oil being at 120 a gallon is just a massive extra piece of wind at the back of the whole sector.
Thank you, Chester. That's great.
Hey, Tyson, can I just jump in with one question for Chet?
Yeah.
Hey, Chet, how are you doing? So, you know, you have some great deals that you're looking at, and where could people look, besides speaking to you as a subject matter expert, where can people look for deals of kind of like these fallen sort of angels in the, you know, ESG space that might have, you know, a leg up, right? For example, there's no doubt the decarbonization movement is continuing, regardless of whatever the price is going to be for energy. So, you know, any thoughts of like great places to find opportunities, or, you know,
yeah, I mean,
check something out and then consult with you?
Sure. I mean, where we find them is in the public markets, it's a bit more reactive, right? So that's where to some degree, obviously there's a ton of private opportunity and there's a ton of big private opportunity, and many infrastructure projects can use the longer fuse of private, right? But in the near term, if you're looking to take advantage of this pullback, the public markets are a little bit more reactive and open up that window of things getting oversold and over distressed. So that's kind of where we found some opportunities. We generally go in, as we mentioned, with one of our companies like Enphase with converts, but I mean, almost anything in tech that was $10 is now $2, right?
So let me phrase it differently. Were there a lot of SPACs and reverse mergers in the ESG space in the last couple of years? And would those be great opportunities for us to look at, since SPACs have been crushed and
yeah, exactly.
mergers?
SPACs are a perfect example of seeing that public pressure get rationalized very quickly, right? So we haven't seen, for example, your point, Marty's right on. Like in the SPAC environment, maybe you had some of those things run from 10 to 40, but now they're back at $3, right? And so the SPAC environment's worth looking through. And for example, in the EV charging space, Enphase, which is one that we're funding now, the peers are all SPACs, right? They've all come through SPACs, and they've all kind of gone through that up and down cycle. Obviously, you want to pick carefully, but at least you have the public visibility and the public information to make your assessment on the SPACs. And now they're pretty rationalized. Where in the venture side of things, the private equity side of things, I don't think you've seen that secondary distress come out yet, right? It's still unstressed, but in the public side, the stress has been clear and abundant, right?
Do you think that there will be some take privates out of this SPAC, or out, you know, like some maybe they're like Reg A's that happened that were just too early, not ready for prime time? Thoughts?
Yeah, I would say it depends on the burn, right? For some of the auto companies who had such a big bogey and a big burn, they may actually get taken private or just taken out. Some of the other things like charging companies, Blink and Beam et al., they probably are just more to pick your favorite, right? That seems to have if they have a good business that's ramping, it's a little bit more conservative and the CapEx bogey isn't so huge. Right. So I think it depends. You have to go kind of case by case, but yeah, no, absolutely. There could be definitely some take privates on the SPAC side of things, or some restructurings. So you want to definitely do your homework and tread carefully.
Sure. Any questions from the audience here? Any thoughts
I
yet?
want to get the best ideas from some of these other people too.
Tyson, I got 3 minutes. I just want to do one more question. I've got a live member here from the audience. I'm going to ask a question.
Go ahead.
I just wanted to know if the panelists have seen in late April, there was an astounding article, very useful, by Professor Broadwall-biz, who wrote how the real word really works.
Article from Vakov Smiel? Schmiel?
S-M-I-L.
On how the real world works?
I can send
Yeah, it's a great book.
Yes, yes.
Great. So Paul's going to send it. We're going to get in contact, spread the word. I'm sorry, Tyson, you've got 3 minutes. Best
So,
ideas.
Okay, best ideas. Go ahead, Jennifer Warren, then Caroline,
Do you want to send
Lewis,
it to me? I'll
and
just-
then Chet.
Okay, so favorite best ideas. Well, the things I'm working on privately, I think are the best upcoming ideas. And the things I'm working on, one, an energy edition coming out in late October, where I'm going to be talking to a private firm that's a oil and gas legend doing things internationally. Some serious deal action there. Oil and gas markets, I'm, watching all that, and yeah, it's, Pioneer is great, and its peers. I also work with a private client, and we're doing some exciting things, private also, but you never know, well, this is going to go somewhere. But right now, we're developing things with within the real estate, energy, ag, resources nexus, and that's my area, and it has been for a long time. So I'm putting it all together. And then the other thing that I'm working on is it's from EarthX eCapital Summit, where I got to see all of the edgiest, innovative, clean tech, climate tech, you name it, tech is happening. And so I've locked on to some of those innovators, and we're talking, and they're doing exciting things, and everything, wave technology, cold fusion, you name it. And so I'm in this space of all of it. I'm in the mix of everything new, everything incumbent, and putting it all together. So that's kind of my wacky world anyway.
Okay, next.
Thank you, Jennifer.
Sure.
Caroline, best idea.
Definitely my fund, which is it's our first fund, our $150 million fund, revenue positive companies. Our big sectors are waste to value, material science, and energy. And honestly, we have so much opportunity right now. There's so much in our pipeline. And I really, you heard my roots. There's a lot to do in natural gas specifically, and offshoots in terms of the GHG reduction, carbon capture, hydrogen, lots to do. And, waste to value, it's literally everything. It's plastics, municipal solid waste, organics, into clean fuels, into energy, sustainable fertilizer, and material science. It's literally using all of those wastes, but, others using biology to create, new materials for building, for clothing, for consumer. So super exciting. And we're going to get there. So that's my prediction, is that we can get there on Paris Accord.
Hey, Tyson, you guys are winning the shameless self-promoter panel award.
Okay,
Keep on
so
going.
Lewis, give us a great idea to make us all money.
We have to.
You're on mute, Lewis. Unmute yourself.
Yep. So I like uranium and the downstream towards uranium all the way to refining. So I think there's opportunities for refineries here in the US, particularly to separate the dependency on Russia, which controls 40% of the fuel rods out there. I think uranium miners are, finding the opportunities. It is a volatile market, but it is an incredible opportunity, particularly once uranium prices start to reach $75 a pound. You're going to find a lot of mines begin operations again. There are other fine detailed points that I'm happy to highlight after the call. I also like regenerative farms. So finding regenerative farm opportunities, organic farms that are converting to organic, and regenerative farms are even better. Water rights is a great place to play in ESG. And then coal. That's in the short and intermediate, and some in the long term. And then 5 to 10 years from now, looking at things like green steel, which uses hydrogen in the production of steel in lieu of coking coal, is both more efficient and less costly. And you have a couple of firms, one in Sweden, which is actually sent out its first delivery, and they're starting to do exploratory prototypes on sheet metal for auto manufacturing. So I think green steel is a really interesting space to go.
Thank you. Chester.
All right. Well, mine, I'll make it easy and simple. A company that we had in yesterday to the panel, to the conference, Enphase is probably my favorite right now. I've just never had something with more upside. They do EV charging, but with a cloud-first approach. So they have a kind of a network-based approach to EV charging for consumer engagement to make the charging experience better. And bottom line is, from our perspective as a fund and a moneymaker, this thing trades at 1/100th of the value I think that it can be realized. It's profitable, fastest growing, highest margin EV charging company out of any of the peers. And it's trading at literally 1/100th of the value. So it's one that I think you'll see recognition come to as it ramps. I think they just won 19 brands in the marketplace, from McDonald's to British Petroleum to hotels and Hilton and so on. And as that gets recognized, this thing will just skyrocket. I've never had one with that type of math or upside potential, but I'll give you the ticker, XDSL, and watch this one closely.
Thank you, Chester. I'm going to add one myself. I am an investment advisor. 2 years ago, I bought a company called Antero Resources, and they're a natural gas company. I happen to know a guy who was a co-head of energy M&A at Citicorp, and somebody else said, geez, these natural gas companies got a lot of operating leverage. I know those guys at Antero. They're very smart. They're investment bankers with me over at Lehman Brothers. And at the time, a lot of people worried about a debt wall they had. But one thing I noticed about the company was they're buying back their stock and their debt. The stock's gone from 1 to 48 in 2 years. And actually, I thought it was so interesting and emblematic of how oversold energy got. I did a screen, or I have one of my quantitative analysts do it. We pulled up 29 energy stocks that are literally buying back their own stock and debt right now. And I think that says a lot about the energy space and the opportunity it is. And so this is a very exciting opportunity. Marty, thank you so much for your time. This is a great opportunity. We hope we can do it again.